Today I'm excited about our guest speaker. I'd like to introduce Mr. William P. Angrick III, who's the chairman of the board and chief executive officer of Liquidity Services Incorporated. Mr. Angrick has served in this capacity since January of 2000, after co-founding the company in 1999 in response to the growing need by corporations to find more effective methods for surplus and return management and disposition. Prior to that, he served as vice president of Deutsche Bank's Alex Brown's Consumer and Business Service Investment Banking Group, where he provides strategic advice to rapidly growing companies involved in the business services, e-commerce, and direct marketing sectors in the U.S. and abroad. As a leading advisor on excess inventory and returns solutions, Mr. Angrick has appeared on ABC's World News Tonight with Charles Gibson, National Public Radio, CNN, Fox News, and eBay Radio. His insights have been quoted in leading newspapers around the country, including the Wall Street Journal, the Washington Post, Investors Business Daily, Business Week, Associated Press, the Washington Times, and the Christian Science Monitor. Mr. Angrick holds an MBA from the Kellogg Graduate School of Management at Northwestern and a BBA with honors majoring in accountancy from the University of Notre Dame. Mr. Angrick earned his CPA certificate in 1990. He also serves on the Mendoza College of Business Advisory Council and on the board executive committee for Big Brothers and Big Sisters of the National Capital Region. And what I particularly like about Mr. Angrick's career is how he's evolved from his undergraduate studies in accounting into financial services, which I think a lot of finance majors see themselves doing, and maybe not so much accountancy majors, and we again try to break down that paradigm, and then ends up going on and becoming an entrepreneur, establishing his own company. So hopefully you'll take advantage of that track in your Q&A. Again, I'd like to extend a warm welcome to Mr. Bill Angrick.
Thank you. It's great to be here on a football Friday. You know, we got in late last night. New Morrison, it's a shining new building. But guess where everyone wanted to be? Roar's Pub. So I met a couple extra friends and my former roommate there. We got acclimated. It's always great to come back to campus and share with you individual experiences in the corporate world and the business world. In today's experience, I'd like to talk about really three things. My journey, our company's journey in developing a market leader, true global market leader, and the entrepreneurial experience along the way. We'd like to talk about some of the milestones during this 14-year journey and lessons learned that you may be able to apply in your situation. And then how the Notre Dame experience, in my view, prepares you for a lot of the things you're going to encounter in the business world. So the first thing we want to talk about is entrepreneurship, because I think that's the lifeblood of the United States economy, if not the global economy. It's allowing people to bring new ideas, new energy, new vigor, and reinventing and refining and improving the world. And in my view, that's quality of life and the quality of living as a result of those ideas. So the first question you have to ask is entrepreneurship for me? What does it mean to be an entrepreneur? What are the characteristics that define an entrepreneurial experience? And so this is something that's not as tangible. It's not scientific. It has attributes that you learn by experience. So let's reflect on some of those themes and attributes. Well, the first thing that I wanted to share is, what does it mean to be an entrepreneur? One of the things it means is an indomitable spirit and the ability to overcome obstacles, however great those obstacles may be. And, there was a famous general in roughly 200 BC, Hannibal, who led a small country, Carthage, in the northern part of Africa, and they were being attacked by the Romans, and he was in Spain, and his countrymen were asking him for support, and he said to his generals, hey, I need to go through Italy and the Alps to get to Rome and take away some of the pressure, and they said, you're crazy. You cannot cross the Alps. And his response is, I'll either find a way or make one. So when you capture the spirit of that, overcoming obstacles, not being denied, that's entrepreneurship. I think the other thing about entrepreneurship is that you embrace failure. Failure is not a bad thing. Failure is a pathway to success, and you learn. You're a learning machine. When you're an entrepreneur and you're an entrepreneurial organization, you're always learning from every experience. And one of the great inventors of the last millennium, Thomas Edison, was constantly failing, constantly refining, and had a positive outlook on it. Every failure was just one step closer to success. And also the notion of, hey, you've got to really show up and want to roll up your sleeves and work at it. In fact, I would say 50% or more of the weighting of success is just continuing to persevere, continuing to grow, continue to stay on your focus. I think the other aspect of entrepreneurship is it can be very lonely when everyone is doing a business or an activity in the same way, and you're off over here trying something completely different. And it takes some courage, some personal comfort to listen to your own intuition and to take your own approach and to be different. And that's why I think, Stephen Jobs captured that very well. As you go through life, you're going to hear that inner voice. Does this feel right to me? Do I have instincts that are taking me in a direction that I think has possibility, and following through on that, not being concerned about the fact that you might be the only one doing it. You might be on your own for a period of time. But that's typically where the seeds of innovation start. Why do we have coaches here? Well, one, I like to channel Notre Dame when I'm back in South Bend, so forgive me for that. But I think the other important thing about entrepreneurship, and you see this in great coaches, not just here, but in other endeavors, great coaches make great adjustments. They might be down at halftime, but they're rethinking their strategy, and they're constantly iterating. And the folks that have come through Notre Dame and given it such a great history, or all of these gentlemen were great innovators and made great adjustments. And the father figure here, Newt Rockne, you may know his history, but this is a program that was shunned from the Big Ten. This is a program that didn't have a lot of history and tradition getting the best players. And so you have to work with the resources that you have. Limited resources is often the challenge of building small businesses to bigger businesses. And so here's a guy that in 1913 took a quarterback who's 145 pounds, taught him the forward pass, and they go play the best team in the East, West Point, Army, and demolish them. And that put Notre Dame on the map. And so too have these great coaches made those adjustments, worked with the talent they had, and got optimal outcomes. So when you look at the U.S. economy, how does entrepreneurship fit in, and how does the public markets fit in, and how many large public companies are there? Well, in the U.S. there are about a little over 7 million businesses. That's 2010 census data. This is every restaurant, every dry cleaner, every manufacturer, every service business in the U.S. economy. There are about 24,000 venture-backed companies. Venture firms are typically looking for the opportunity to invest and scale and grow very large businesses. And so they're a very small percent of U.S. businesses that are venture-backed. Less than 1 out of 300. In the U.S. today, there are only about 3,700 public companies. And so these are typically the most investable companies that have survived that process of idea, commercialization, growth, success. They defined a product or service with mass appeal. They've got a profit model, a business model that is interesting, and they've made it to the public markets, and they've thrived in the public markets. Hopefully. That number's actually coming down. The Wilshire 5000 tracks the largest publicly traded companies, and this number might have been 5,000 just 8 to 10 years ago. And there are reasons for that, which we'll talk about later. And then of these public companies, about 1,700 of them have come public and then got to $1 billion of value. And there are lots of reasons that companies don't quite get to that scale, but it gives you a sense of you want to get up here. If you're looking to create value, you're trying to move up this pyramid, and it's a small, rare club. One of the things about being an entrepreneur and building businesses, particularly in the public markets, is that markets are volatile. In fact, most people are emotional. Investors can be emotional. And you have lots of peaks and valleys. And the reason people are attracted to building and growing businesses is not to make money. It's to follow a passion to create something of value that your customer wouldn't otherwise have access to. And along the way, if you touch enough people, if you have enough transformation, you're going to create value. And what I thought was interesting, in the era that I started our business, we were seeing this massive run-up, this euphoria in starting businesses and taking them public. This was sort of what we call the dot-com bubble era, when the first versions of internet companies were being created, and there was sort of endless possibility, this new medium. I can do anything on an internet-based economy. I can sell pet food on the internet. I can sell CDs and music and books, and I can sell apparel. And so you had this huge run-up. And during this time, there were a lot of people that thought, hey, this is pretty easy. I can start a company, I can put a business plan together, I can raise venture capital, and poof, I can go public and make a lot of money. And so there are a lot of people that piled in right around this time to starting companies and raising venture capital. And these are what I would call LIFO entrepreneurs, an accounting term that I'm sure you all know. The last in and then first out entrepreneurs. Because guess what? This was not sustainable. This wasn't reality. And so the real work to be done in building successful businesses, not a 12-month or 24-month exercise. It's a 5, 10-year, perhaps a lifetime exercise. So you really need to be thinking about, why are you going into this business? Why are you looking at becoming involved with a startup, leading a startup, being an entrepreneur? It's not because you think you can turn a business plan into an IPO in 12 months or a couple years. And so what we found is the market can turn very quickly, and most of our progress and success occurred after this bubble. And so you just need to be very focused, very disciplined, and understand it's a marathon, not a sprint. So along the way, what I'd like to do is share with you how we think about our business. When we do our planning, when we do our multi-year investment and hiring decisions, it's on a 3 to 5 year basis. We think of sort of 5-year chunks. And each era for us had milestones, challenges, disappointments, but it was a gate that we cleared that allowed us to go to the next set of opportunities. And so in our first years, founded in November of 1999 in Washington, D.C., so this is a very naive young man thinking, hey, I want to start a business, and I'm looking for opportunity. I'm looking for a market that is inefficient, unprofessional, and it's not crowded. It's not crowded with incumbents that will prevent a new business from rising. And so with a small group and $100,000 of seed capital, we subleased office space from the Al Gore campaign in 2000. Al was rebooting his campaign in Nashville, so we got this space very inexpensively. And we started working with small wholesalers based on a vision that, look, there's a huge untapped market out there in the liquidation space. You have, on the one hand, sellers that don't really have any professional way of disposing of inventory and equipment, classified ads, live auctioneers, calling their local dealer or broker. So it was an underserved market, and then you had this notion that in an era where you have transparency, you can go online and search for things. There are plenty of buyers for this product. They just need to know where they can go to find that inventory or material and have a trusted service provider to fulfill their needs. And so together that represented a very large market and an underserved market, and so that's where we focused. And our vision was focus on business clients and with some key principles and pillars. One is transparency. We felt if you could expose the global supply of inventory and equipment online, that would be a winning model for buyers. Two, if you expose the price that you achieve for these items and share that upside created with sellers, that alignment of interests was a winning model. So if we're able to double the value of goods, we're not going to keep that profit for ourselves. We're going to share that upside with our clients so they can benefit. The innovation comes from, instead of shipping trucks or pallets of inventory around, let's virtually move information so that if there's a buyer in the next city, the next region, the next country, they're able to access that by using an online platform. And so online marketplaces was our focus, sort of an eBay for business to business, and providing whatever services are required to remove the friction from the process. So that was our vision, has been our vision since inception. So we got that vision right, and then we had a decision, okay, how do we want to finance our growth? And this is just a 4-quadrant matrix. Most businesses are bootstrapped, friends and family, credit cards. You're looking to find enough capital to get you to your next milestone, opening a store, buying your inventory, buying the truck you need to deliver goods and services. And so that's where most businesses start and end. They are businesses that will grow to one location, a few $1 million. The question you have to ask is, if you want to build a large business, two things. One, how scalable is your business model? Does it require a mass of people or a mass of capital to execute that plan? Those that require a mass of capital are typically not great candidates to be large global enterprises. Simply, the returns are less. It requires constantly being out raising money, and it's definitely not going to get the attention of investors. So the sweet spot you're looking for is, I want to be in a scalable business and one that's pretty cash flow positive and high return. One of the reasons for that is if you can reinvest your profits, you have control over your organization and you can continue to fund your research and development, your hiring, and so forth. So for our business, we started here and then we worked very well to bootstrap our way. And in addition to personal funds, we raise funds from clients and customers, which I call business angel investors. Instead of immediately looking to venture capital, we looked at the opportunity to use venture debt and other types of rounds of capital to maintain more ownership. But ultimately, back in the era that we started this business in, having venture capital sponsorship was important as a stamp of credibility. And so we made the decision, we want to raise venture capital, we want to build a large company, and we think we can both scale the business, and we think the business has an opportunity to be cash flow positive within a reasonable period of time. So you may have a scenario in your career where you're looking to raise venture capital. You may start a business that you think meets the criteria of becoming a large business. What is it that venture capitalists are looking for? Well, in our case, we found there were a couple important areas. One, you need to have a big market. A market that is large and has opportunity for transformation, for innovation. Okay, there's not a lot of interest in selling horse and buggies anymore. It's not a big market. But what about a global market for healthcare services or biopharma solutions, or an e-commerce marketplace to sell surplus goods? That's what we brought to the table. Venture capitalists are looking to invest in the people as much or more as the idea. So it's important that you really understand the area that you're seeking to get funded. And this does not mean that you have to be 10 years in the industry. The question might be, well, isn't there a dilemma here? If I'm a young person, how do I show a track record? Well, if you've done your homework and you really understand what your customers need, why they need it, and the opportunity to improve on current solutions, then you have domain expertise. And that domain expertise is really what needs to back up your plan and what funding sources are going to be looking at. And it's helpful to have some track record around being committed, having high integrity, following through on your commitments for the purposes of building trust with that funding source. I think third, you need to show why this is great for the customer, why the unit economics of serving that customer are compelling from a business point of view. In our example, we were able to take the same items and improve the value by 30, 50, or 100% versus traditional sales methods for excess inventory and used equipment. People would sell to a local liquidator who had one motive, which was to buy low and then sell high to someone else. So we had a great value proposition for sellers to use the service. The other thing that is important to understand is, what's the competitive landscape? Is there anyone in the space that you're seeking to build a business? Are they already driving innovation? Are you playing from behind? Or are you a first mover and potentially, in time, a market leader? And certainly that is something that venture capitalists are always looking for, and where we felt we could take an early incubative market and improve it. The other thing is scalability and having an efficient business model. It's so important to understand that the more you rely on outside funding sources in building your business, the less control you have on your future, the less control you have on the destiny and the outcome of your business. So it's important to focus your attention on the segment that gives you the greatest chance of becoming cash flow positive. So once you hit cash flow positive, you're going to have, in time, greater control over the organization. You're going to have less dilution to shareholders, and you'll have the satisfaction of seeing your business execute a multi-year strategy that's not constantly being challenged by lack of financing. So for us, we went through that process. We met with 100 venture capitalists in a period late 1999 and early 2000, and this was a challenging process for us. The curtain was starting to close on dot-com financings, and we just had to be continually building our business in small incremental steps while we're raising capital. And there's a poor notion that one goes to a venture capitalist, and if you take the view that if I had the money, I could build a great business, and that's your pitch, you're going to be turned down. That's not the approach to take with venture capitalists. You need to be taking the approach that, this is happening. My business is compelling for the reasons we just discussed. The train is leaving the station. You need to be on the train if you want to create upside for your fund, and almost creating a scarcity value for potential investors. And that's the mind frame that we took, and we raised a total of $12 million between January and May of 2000 to create the foundation for LSI, Liquidity Services, ultimately to become viable. And mind you, at this stage, we're very incubative. Our revenues are around $50,000 a year, and our head count is maybe 8. So this is something we celebrate as a great success. When you take other people's money and you have investing relationships, partners, you want to understand what their motivation is. So if we take on a venture capitalist or a private equity firm, you need to understand what their agenda is and how you create value for your partner. And if you look at the data on about 12,000 companies that were funded in the era that we were funded, here are the outcomes. Only 14% of them actually made it all the way to being public. And so that tells you a lot about what your probabilities are, what you should realistically expect when you raise venture capital. Another 33% were acquired, which is a great outcome for many companies. There are lots of reasons selling off your business and allowing someone to make the next set of investments and returning capital to your investors. It's a great outcome for everyone. So that means 47% of the time, something conceivably good happened, but the other 53% of the time, you didn't have a good result. And there are lots of reasons for that. One of the things we saw in the early part of the new millennium was, the euphoric market, and people were overly enthusiastic. The market was overbought. And then on the other side of the coin, shortly thereafter, the market was overly pessimistic. And many venture firms who had made that $5, $10, $15, $20 million investment in a company were very reluctant to follow up that investment, and as a result, closed down those companies. Took their money back, resulting in a lot of dot-com implosions, a lot of failures. And that's one of the things around being comfortable with taking on that third-party investor, understanding their agenda, understanding their investment time horizon, and make sure it maps well with yours. So back to Liquidity Services, we continue to build the business. With this newly injected money, we built an e-commerce platform, very unique, focused on business buyers. And we said, look, buyers want to find and buy the products we have. We need to make it easier for them to find and buy the products. And we said, look, on the demand side, this is what buyers want. They want to be able to source things online. It's easier for a small business to pull out their laptop, identify the equipment and material in the inventory that matches their needs than to drive around in a pickup truck to go to live auctions. They want a large supply of inventory. They want to save money. They want to feel like they're getting a good deal. And one great thing about our marketplace is everything is sold typically below wholesale cost. It's a cost recovery. They need a turnkey logistics operation because not only are they buying, but they need to have that item shipped and delivered to a place of business. So low-cost fulfillment is important. And probably the most important point in the currency of any marketplace, whether it's the NASDAQ where you buy and sell stocks or a healthcare exchange or an online marketplace for surplus goods, is trust. Can you trust that when you spend thousands or hundreds of thousands or millions of dollars, that the sponsor of that marketplace has business rules in place to protect your interests, that you can transact in a positive manner and your interests are protected? So trust and transparency have been very important to the buyers. And of course, we've taken account of these needs and built out functionally and with our clients all of the things that meet those needs. We provide online transparency. We have a one-stop shop in 500 product categories, a lot of very important products at lower prices, turnkey logistics, and we collect the funds and make sure our buyers feel good about every transaction. So we started with that model, and we worked with individual clients where they had a need, and we said, look, use this service and let us demonstrate to you that we can create value. And we did it one seller at a time. In this example, simply we took some test and measurement equipment, the District of Columbia, product that's not current technology in the U.S. that has a long useful life, and we put it online and we marketed to buyers nationally and internationally. We attracted 413 buyers who bid almost 2,400 times. They're across the U.S. and across the globe, 33 countries, 36 U.S. states. And this batch of products yielded $311,000, double what the seller's expectation was. So we said, wow, we've got something really special here. This is creating a lot of value for our seller, and buyers seem to like this. They're sourcing product, and they're finding something of value in the service. We really have something here. This is great. So with that experience, we realized that our success was depending on creating success for our customers. And that's an important insight in any business. Understand your customer's business, how that business can be made more successful, and then help them make it successful and become an extension of their mission. So we've become, in our early experience, we validated that we're an incubator for small businesses and entrepreneurs on their own, because they buy things from us that are a great price, that have a lot of functional or utility value to them. They can test, refurbish, use the item in a business, or they can resell the inventory for a profit to sustain their own business. So we had a lot of interest from entrepreneurs who bought products from us. Here's a guy who has a honey production equipment, $100,000 business. Here's someone in Hawaii who used pumps and valves we sold, generating a nice business growing coffee beans. Here's a young man in Georgia who bought a surplus bus, created a $100,000 business taxing students to and from events in Georgia. So the idea that you can create value for your customer is really a core principle in developing successful businesses, and understanding the needs of both sides of the equation and how it's a win-win business model is what we call a network effect. And for us, we started by adding more supply and more products in our marketplace, allowing those listings to be exposed to buyers. All of the auction content on our marketplace was very attractive to organic search results. That resulted in more buyer traffic and more transactions. And an auction depends on having 2 or more qualified bidders to compete to get the true market price. We were able to average 4 or 5 auction participants for every completed transaction. So we're getting more lift. We're improving the value realized by our sellers. And when you get better results for sellers, you have more interest in selling on our platform. And so that's a self-reinforcing growth dynamic that you want to see in a marketplace business model. More buyers means you create greater demand for your sellers, which attracts more supply. Buyers want to be where the supply is. And so that network effect was important to us. So an important decision we had in 2001 is to understand where do we need to focus to ensure profitability. And while we had demonstrated great results for a small number of clients, many of which were small government agencies, we were finding it very challenging to introduce this online liquidation marketplace to large retailers and commercial sellers. Why is that? Why was that? Well, when you have hundreds of e-commerce business models failing regularly, and it's on the headlines of most business press, undoubtedly that creates a negative bias in the management that's making the decision on using your service. So we felt this dot-com implosion and hangover from 99, 2000 into 2001 was going to be a very tough thing to overcome. And so we looked for business in the public sector as a result. And we said, here's a marketplace where we've got valid case studies to show strong performance and where there's going to be a lot better success than bang our head against the wall trying to get in to see these large corporations who have a negative bias about anything with .com in the name. And so being based in Washington, D.C., we'd always thought of the public sector as a viable path to grow, and now we had to really put all our eggs in one basket because time is precious, funds are getting low, we need to make a decision. So fortunately for us, we went after a large piece of business with the U.S. Department of Defense, which was seeking to create more value in the way that their surplus equipment was managed and sold. And we had a really compelling value proposition for that agency in terms of the unit economics, in terms of the transparency, in terms of sharing the upside with that client. So we competed for and won a significant piece of business with the Department of Defense. This is a huge milestone for us because it allowed us to scale our organization with a client that had a recurring need with a large volume of assets. And for us, that was a bet the farm decision. We put all our eggs in this basket to make sure that we could serve one of the largest and most complex organizations on the planet to meet a number of their requirements. One, this is an organization that had surplus property being received in 400 individual locations in the United States. 400. And had staffed roughly 200 of them with individual personnel to conduct a sale. So we said, look, we need to replace this people-intensive manual process with an online virtual marketplace and then consolidate the way this property flows physically. So it required us to combine the best of our e-commerce platform capabilities with physical logistics skills to track and manage this property while it's going to market and safeguard that property and make sure that only qualified buyers were able to buy that property. And as a result, we said, look, we're going to become not just an e-commerce play, we're really a services play in helping these large organizations deliver on their value. And so we changed the name of the company from liquidation.com, a business-to-business auction marketplace for surplus goods, which still exists today, is very vibrant and growing. But the company was really more imbued with, hey, we're a turnkey solution, we're a services organization, and we'll resolve all of your problems. Large organizations want a do-it-for-you solution, and we're going to do that for you. We're going to be a services organization. So we changed the name of the company following this award. And I'm looking pretty happy here because it's new business. But this guy here who's running the finances, he's kind of worried because there's a lot of working capital that's required to run this organization. There's a lot to do, and we're saying to ourselves, have we bit off more than we can chew here? And this would be a very public failure if we were not able to support the needs of a prestigious federal agency. And to make matters worse, we went back to our original venture capital investor and said, hey, you had great news. This is in the spring of 2001. We got great news. We've won this big contract with the U.S. government. We're going to roll this out and make it just a terrific outcome for everyone involved. We need $3 million of additional capital to fund the working capital requirements. And their response was, we've just made a decision to wind up our investing portfolio. We're exiting all of our investments, and we're not going to fund this additional working capital. So we're sort of betwixt and between here and quickly need to come up with a plan to raise this incremental money without the benefit of our existing investors. So we devised a solution to bring in additional investors who make a note investment in the company with a very high interest rate that allows us to bridge the time elapsed from the contract award to the rollout of the contract, roughly a 9-month period, and to fund the working capital requirements of expanding our workforce from about 35 to about 200. And so this was a moment, a crucial moment in the development of the company, and one which required us to really laser focus on serving the needs of the DoD and also raising capital in alternative ways to keep the process moving forward, to keep evolving. We were successfully able to do that by reaching back to some of our early business angel investors. The management team kicked in what they could, and we got the $3 million to keep the process moving forward, critical time for the company. Now that we had the customer and the capital, it was time to execute. And I think execution really is what matters in any business. Ideas, lots of ideas in the world, but really what matters is execution. Very few people can take great ideas and execute them well. And so for us, at this time in our history, 2001, 2002, 2003, we were able to execute on the promise, and we doubled the value of DoD surplus sales. We reduced their fixed costs by $20 million a year because they were able to repurpose or reduce their workforce. And so this was an unqualified success, and we were delighted to work with very senior people, and we won this Defense Logistics Agency award 4 times in the course of serving this client, and that is head-to-head with the biggest suppliers to the U.S. Government, the Boeings, the Raytheons, the Lockheed Martins. So we felt very good about this, and it built a lot of positive momentum on what was possible. We said, look, if we can solve the needs of one of the most complex agencies in the world, we can solve the needs of any corporation or any other agency. So it really was a good proof of concept for us. So during this time, from 1999 to 2003, our first 5 years, we started, I think we did 50,000 revenue in 99, and we got to 72 million of gross revenue. And we survived this shakeout period. And getting to profitability, incredibly important. We never had a scenario where we were comfortable continuing to raise capital and give up control of the organization. We saw that companies that were giving away more than 50% control were getting shut down or getting jerked, in different directions because you had these transitional owners that weren't patient, weren't willing to take the company to the next level over 3 or 5 years. Lessons learned for us, one is, you've got to look at all of your alternatives when you're raising capital and be creative. You're in a difficult period when you're doing venture finance. You should consider venture capital, but also mezzanine loans. You have mezzanine debt sources that will be happy to put money into a company if they have a small share of the upside through warrants. You have friends and family who could invest on a note basis and get high current return if you can show that you have the cash flow or the receivables to pay their interest. So that was what kept our company going. Iteration. We talked about how important it is to make adjustments. Like a coach at halftime, he says, well, how are things going? I need to make adjustments. We made an adjustment based on the feedback of the marketplace. The retail supply chain was not ready for our service. There was a taint around e-commerce and .com businesses at the time, so we went after the public sector. Important decision, and you have to iterate. Really locking into the customer need. You really understand their business model. How do they define success? Not what your perception of success is, but how do they define success? And make sure that you have an unwavering focus on meeting their needs, and that leads to good results. And then profitability, for the reasons I discussed. Positive cash flow is your best friend if you're building a business, and we were able to get there through this focus and work with the DoD. So then we have the next chapter of our business over the next 5 years, 2004 to 2008. So we're growing as a private company. We've had some near-death experiences for sure. We've got a signature win with a large agency. Question is, well, where do we want to go next? How can we take the learnings and the size of this marketplace and continue to grow it? So we looked at the retail supply chain and we said, well, what do you see when you look at the way products move around in the retail supply chain? You have lots of retailers who each have these relationships with lots of vendors. And what we saw is the way product is moving back and forth, particularly after it's sold, you see complexity. So when you look at retail in America, about 5% of everything sold at retail is returned to the store for a variety of reasons. Buyer's remorse. I watch the Super Bowl. I don't need the TV anymore. I can't make the item work. That is a drag on retailers' store operations They don't want to have those items in their warehouses or facilities. It's a negative margin process. Online retailers' return rates can be much higher, 10, 15, 20% in certain categories. So the growth of online has exposed retailers to a lot of returns. So the challenge is every retailer is dealing with 50, 100 vendors who all have product that are in the secondary marketplace, and they each have sometimes competing interests. Retailers want to get it out of the way and dump the product, but the manufacturer, an HP, a Sony, an Apple, they don't want their brand showing up anywhere. So you have this complexity. And so what we saw is, look, there's a lot of complexity here. You have multiple return to vendor and liquidation agreements. You have several touches and several shipments of the same item. Every time you touch it, it costs money. You risk damage. This is not a sustainable business model. The brand can be impacted in the way it's sold in the secondary marketplace. And then the longer it takes, the longer that item is sitting in a warehouse, the less it's worth. So we said, look, this is an interesting area, a lot of complexity, and we can help solve that. We can get in between the retailers and the manufacturers, create a central process by which these items are tracked, cataloged, manifested, and sold, and we can create a lot of value in this market. The first thing we had to do and recognize is the physical flow of these goods required distribution center capabilities and logistics support. And there was this dogmatic view in the early days of e-commerce that I have to be a pure technology company. I would never want to touch inventory. I'd never want to have warehouses. But that doesn't map to the need of the marketplace. And we were flexible about that. We said, look, if we get people introduced to our logistics services, we're going to have greater integration with our clients. And so we started with one facility in the Dallas area, and Walmart started sending returns to us here. And then we just continue to add based on growth regionally of our services. And this solved a lot of problems. One, manufacturers could just tell the retailers to use Liquidity Services. They didn't need to take the product back. Two, we were able to receive and sell the property more expediently for more money. Three, people saved the transportation costs. They viewed this as a more sustainable business model. And so we had a lot of economies of scale that our clients lacked to create value. So this is an important decision for us to get into the integrated logistics services business to meet buyer and seller needs. And since then, we've added a facility up in Toronto. So we're now in two industry segments. We've got our DoD business and federal and some smaller government agencies working with us. That's going great. We're launching this new ambitious program for the retail supply chain. There's early uptake of that. We have some signature customers. And so we're saying, what do we want to do now? And along the way, between 2002 and 2005, we allow an investor to make an investment in the company of about 19%, and that provided some short-term liquidity for the owners for the hard work that had been done that time. And with that investor, we had the decision, ultimately, do we want to create this business as a business we want to sell, or do we want to continue as an independent company and take this company public? In either event, we need to create a liquidity event for our investor. And so we began to think about an IPO. And that's a big deal for any company. And so we looked at this. What are the pros of becoming a public company? Well, certainly you can really put a stamp on your value proposition and really brand the company as being a thought leader in an individual vertical. And you have more people talking about the company. You have a lot of journalistic interest on the business and your business model. So we said this could be a great way to frame the reverse supply chain problem. This really untapped, unknown industry, where a lot of products are not handled well, and there's a lot of lost value, a lot of underinvestment. We said this is obviously a way to, in the future, have access to capital. If you're publicly traded and you want to raise capital, you issue stock and you raise money. So it's an efficient model. The U.S. capital markets is still the best place to raise capital. It has the most integrity. It has the best legal system, and is where many companies throughout the world go to raise capital. having a publicly traded stock is a form of liquid currency that you can issue to other companies, and in terms of acquiring a business, and instead of writing a check, you can issue stock and have alignment of interests. And it can be an incentive for employees. We have a mantra, public or private, that you want to think and act like an owner in helping us build the business and make the right decision every day. And being public allows you to issue incentive stock options or restricted stock tied to performance milestones that really align interests. So those are all positives. And then lastly, ultimately you can help an investor exit their investment once it's publicly traded. I think there's a misnomer about liquidity for inside executives. Going public is not really a liquidity event if you're on the management team. And it's really not the end of the development of the process, just the beginning. And as an insider, you're not going to be selling much stock at the time of the IPO. And for that matter, as you develop the company over time, you're going to have incremental diversification, incremental liquidity, and that's something important to keep in mind. There are lots of best practices on how you diversify and sell as an insider for public companies. But if anyone has this view that there's a big pot of gold when you go public, that's not the case. And you're attracting people to invest in your company, to buy into your long-term growth strategy. Now, the other side of the ledger, there are lots of disadvantages of going public. That's why the number of public companies today continues to decline. It's been down, we're probably down almost 20% in the last 5 or 6 years on the number of publicly traded companies. And there are many reasons for that. One, disclosure. You're in a market that is an attractive market. It's competitive. There are multiple service providers. You want a competitive advantage. And one thing you give up as a public company is, there are lots of details about your business that are now in the public domain for the world to see, for your competitors to see, for your customers to see, for your suppliers to see, job candidates to see. So you have to be comfortable with the fact that you're going to have a lot of scrutiny and a lot of information in the public domain as a publicly traded company. And you need to anticipate that and manage it. And so for the SEC and other regulatory bodies, you have, for example, to disclose any contract that's worth more than 10% of your revenue, the entire contract in an appendix to your filing. So when you think about that, it gives you pause on, do I want to be public? There's non-trivial costs of running a public company. We had our first audit. We always use a public accounting firm when we started the business, and I think our first audit was something like $15,000 from Ernst & Young. Great accounting firm. Nothing but great things to say about Ernst & Young. I think the same audit bill, our first year as a public company, was about $1.5 million. So you get a sense very quickly that your costs in terms of audit, compliance, legal affairs will be considerably higher as a public company, and you need to be able to develop the staff, the processes, the understanding of what that investment entails as you plan for the next 3 to 5 years following going public. Public companies have a duty of care and a duty of loyalty to the investing public, a fiduciary responsibility. And that's a responsibility shared by the senior executives as well as an independent board of directors. And the board governance structure for a public company is very central to the notion of being public. You may have a founder, CEO, personality who's always had the ability to make the decisions, who can, go to the golf course and say, we're going to go into this direction, we're going to take on this new market segment, we're going to launch these products, go get it done. Well, as a public company, you need to share that decision-making responsibility with an independent board. When I say independent, the majority of the members of the board need to be arm's length from management. Ideally, they have expertise, They have a track record, and they have an interest in the growth and development of your business, but they might have an independent view on the best way to get there. And so really, the board exists to, one, protect the interests of minority shareholders, two, to confirm and challenge the strategy of the organization to make sure that the CEO and leadership team has thought through all the potential risks and alternatives before advancing a business strategy, to make sure it's a sound strategy. The board has a responsibility to understand enterprise risk. Where are those potential risks? And are we doing the right things to mitigate those risks? We're not just a profit maximization enterprise. We also want to make sure we're doing things the right way, from a legal perspective, from an HR perspective, from a disclosure perspective. But the best boards, in my opinion, are full business partners. Yes, they're independent, but you want independence. You don't want a carbon copy of what you have inside the four walls of your organization. You want fresh, independent, and sometimes dissenting views to challenge your convictions, to make sure you've got a 360-degree view of what's going on in the world. And so diversity is very important for an independent board. They're partners in helping you achieve the next set of milestones. And I think a positive thing of good boards and good governance. I think the other thing you realize, and you saw on that chart, that NASDAQ chart, investor sentiment is something that moves constantly in one direction or another. And I think at this time in America, there's probably more short-term investor sentiment than we've ever had. And you have a lot of mutual funds, and the average holding period of buying and owning a stock has continued to decline over time. You have computer-generated trading algorithms and more hedge funds that are trying to make money on price discrepancies that can be nanoseconds around information being released. So there's just a lot of volatility in the public markets in general. And so as a public company, you have to be comfortable that you're issuing your results every 90 days, roughly, quarterly results. And people can have outsized reactions to that, positive or negative. And a lot of the times, those reactions aren't rooted in fundamentals around the business. They're not attached to success on a 3 or 5 year rolling basis. They're very reactive to short-term conditions. In fact, a lot of very large capitalization companies typically have issued monthly results for same-store sales earnings and growth, and they've stopped issuing them because of this knee-jerk reaction and the whipsaw that happens in the marketplace. But in the end, the important attribute of successful leadership teams for public companies is they are locked on their 3 to 5 year growth strategy. They're relentless in pursuing it, and they shut out the noise of what the market might be saying. And that's why I like that Steve Jobs quote, because you really have to have your own inner voice and your own conviction of where you're taking the company. And yes, you want to be using disclosure, and you want to articulate that as you move your business forward in that time, but you have to be very thick-skinned and have strong conviction in where you're going. And so that speaks to the last disadvantage of being a public company, is just the amount of time and energy you can spend on things other than serving your client, other than serving your customer. And you have to prepare in advance for that. Hiring top talent, delegating authority, giving them lots of responsibility, being able to measure how we're doing, and free up the resources to manage functions like investor relations, legal compliance, internal audits, which are required under Sarbanes-Oxley. So if you're not careful, you can spend too much time as a leader, certainly as a CEO, too much time in trying to convince an investor about a certain point, spending too much time in investor relations, and not enough time paying attention to your business. So for us, we finally made the decision. We did go public. February 2006, a great day for the company, great branding. We're in Times Square. We get to see our name on the board. A lot of these team members had been with us from the very early days, a lot of sacrifice and pride in what we did. And that was a great day for us. And the IPO process, we're not going to go through this in detail, but there's a lot of work in taking a company public, and it's roughly a 5-month process. From September of 2005 to February 2006, 6, this is a full-time job. And so you have 2 jobs. You're running the company and you're preparing to go public. And you're essentially disgorging every fine detail of your business to lawyers and accountants, preparing an offering memorandum, an S-1 registration statement, and then going to meet with probably the best and brightest minds in the investing world. And for us, over 125, 130 investor meetings. Think of Hardball with Chris Matthews. You're just going back and forth, talking, people challenging you on your conviction in your market, why you think this is inevitable, the way the market's going, how are macro trends affecting your business, why you're going to be the winner. And so a lot of energy, a lot of attention paid to this process, and ultimately it's worth the effort to have a successful IPO. So once you go IPO, very important to think about, you have a different set of skills at this stage of your company. You might have been an individual contributor, you might have run an individual business. Your focus now as a leader is building great teams. Constantly identifying your top talent, developing that top talent, making sure that they have all the resources they need to be successful. And for us, building great teams was an important task for our board, and this is our board on the left. This is a diverse group, and we had these NASA space shuttle jackets made after IPO. We're going to the moon, and that was a great day. But all these team members, you need to invite them in and make them feel a part of the mission, connect with the mission, and they all have diverse experience and background. And if you invite them in and you're transparent and you show them, how you want to take the business from, here to the future state, they're very active and eager participants. And then, this is a director who, unfortunately, on this particular day, he was a West Point alum, and they had just lost to us at Yankee Stadium, so he's wearing a Notre Dame hat because he lost the bet. And I had to take that picture to put it in the scrapbook. But teams, the team members in the organization, we were talking earlier this morning with another member of the faculty about ethical leadership. And I think if you're ethical about the way your business behaves and the people that you attract, you're going to be very transparent. You're going to share your successes and failures. You want people to be engaged on what's going well, what's not going well, why does it matter to them, what's the role they play. And you're also going to trust them. You're going to give an outsized dose of trust to those team members to take on responsibilities, take on assignments, and if they're having problems, they're going to come to you, they're going to raise your hand. But you want to have trust and transparency. You want to have a culture where it's very clear what's expected. You want to have a culture where people feel empowered to do their job. You tell them what the objective is, not how to achieve the objective, and you measure it. Because if you don't measure it, you can't manage it. And those are concepts that we've used very successfully at Liquidity Services that have attracted top teams. We don't take ourselves too seriously. We like to enjoy each other's company. And so on this occasion, I think we did the Marine Corps marathon together. So as a recap, from 2003, we were a $72 million gross revenue business, and we took that up 5 times to $360 million. And along the way went public, new set of shareholders, branding event, ability to define this industry, and we learned, look, you may be great serving one client or one sector, but expand that total addressable market or your TAM. And for us, we took it from serving the needs of a complex agency like the DoD to the retail supply chain. There's a lot of complexity there. Let's leverage our e-commerce marketplace. Let's leverage our logistics know-how and our buyer base and bring value to this market. So if you want to be bigger, you've got to expand your target addressable market. When you bring people in, you can't hire for the job you have today. In a growth business, you have to hire for the job they're going to have in 3 or 4 or 5 years. So the idea is you overhire. You get people that are overqualified for the roles and ensure that you've got the capacity to meet the next set of milestones. And make sure you have great chemistry and great culture. And that's always challenging. You can do a lot of research and diligence on an individual, and make that hiring decision, and you might be wrong 50% of the time. So you're always looking for opportunities to create complementary teams, great chemistry, great culture. Culture defines and can be a competitive advantage for organizations. And aligned incentives. This is a powerful but simple principle. Make sure that your success is derived from the success of your clients. And in our business, we have explicit pricing models that ensure as we improve revenue, we share that revenue upside with our clients and also with your team members. Make sure that you align their programs and compensation systems with what the company's strategic plan is. And a simple way of saying it is you get the behavior you reward. So make sure you're rewarding the right behavior. And a lot of that has to go with aligning incentives. And then scalable processes. You might be able to do something for one customer, great, but can you do it for 1,000 customers, 10,000 customers, 1 million customers? And so developing scalable processes, that's your technology platform, that's your accounting systems, that might be your supply chain, your customer service organization. There's nothing worse than making a bad first impression with a client or a customer, because then you've lost them. So this requires investing constantly to stay ahead of the game and being able to scale. And be bold. If you have the appetite and the passion and interest to build a big business, you're going to have to take some bold steps. And for us, going all in on DoD was one bold step. Going public was a bold step. At the time we went public, we were a relatively small company. We were $110 million of revenue, $6.5 million of EBITDA, pre-tax profit. And, we were right on the fence, but we had this emerging demand. We had a great head start in the marketplace, a scalable model. And so by the end of our first year, we were a $15 million pre-tax profit organization and like a $200 million business. So that was a moment of truth for us. We took the bold step, and it served us well. So more recently, we've taken aim at another market, the capital asset marketplace, very inefficient, a lot of offline auction activity. We said, look, these clients, they have assets, they want to sell everywhere, anytime, they want to achieve the highest return. We bring global reach, millions of buyers. These markets they have compliance restrictions. Large companies like Intel, Procter & Gamble, large energy companies, Chevron, BP, they're very concerned about compliance. And they want global service. And we said, this is an interesting market. In fact, we can expand our TAM, our total addressable market, to all of the most capital-intensive industries where they're constantly upgrading and refreshing capital assets. Every 2 to 3 years, test and measurement equipment in a biopharm lab is updated. Semiconductor fabrication equipment's updated. Energy equipment is updated. Millions of pounds of line pipe that are taken out of the ground, or drilling equipment and rigs need to be updated. Technology, as we know, is constantly leapfrogging each other. So all of these industries became addressable for us. We've developed a strong buyer base. We have large clients, such as the DoD, that sell in many of these categories. We continue to find ways to expose these assets to buyers and grow the buyer base. And we see the trend in the future continue to embrace online solutions. So we took aim at all of these verticals and focused on taking our business from a U.S.-focused, retail, supply chain-focused business to a global organization focused on all these industry categories and leveraging the network effect of buyers sourcing online and sellers needing to recover more value for their assets. And, indeed, most large Fortune 500 companies are truly global. They're expanding their supply chains to growth areas like South America and Asia, looking to capture that next leg of consumer demand. And so we're following them. And that's been important. Another learning point recently has been using M&A, mergers and acquisitions. As a public company with a strong balance sheet and a currency, we said we could take a look at buying complementary businesses, using our balance sheet, and rolling up our industry, becoming a force of consolidation. And there are lots of skills and disciplines needed to execute the integration process. The one headline about acquisitions, it's easy to do the transaction. Very hard, and most of the value add is on the integration side. And so putting a playbook together that anticipates issues on talent management and the sales and marketing systems and operations, what brands are you going to use as you grow, other enhancements to the pricing model has served us well. And here's just a chart of the transactions we've done. There's 6 here. The first thing we do when we look at an acquisition is we put it through our strategic filter. Is this advancing the business strategy? Does this help us with expanding our supply or expanding our buyer base? Are there opportunities to cross-sell and upsell to our existing clients by virtue of the acquisition? Can we expand our geography? Does it add new capabilities? And when we have an answer that's very compelling, then we look at a transaction. We want to make sure the transaction is good for shareholders, and we move forward. And we've been pretty active here with about $200 million of acquisitions, one of which was GovDeals, a business we bought in 2008. This is the largest online marketplace for municipal government surplus. It's grown from about 1,800 clients to about 5,500, 5,800 in 5 years. Revenues 54 to 152 million, and it's quite fascinating. Any local jurisdiction has trucks and earth-moving equipment and scrap metal and technology assets, and we sell all this online. And we helped GovDeals expand their marketing. They started out right here. Each of these dots is an agency client, so they started here, and we've been adding sales and marketing resources, and they've expanded outside of the Southeast area, and now we're in some big markets in California. So if you're ever looking for a great deal, GovDeals is a terrific channel for you. So the other thing we've done is continue to expand the awareness of our brand, our value proposition. We've been very fortunate that during our time as a public company, we've succeeded, we've outperformed, and we've been put on a number of sort of watch lists, and we've been able to go on various media outlets to talk to our buying customers and bring them into our warehouses, really excite people about the possibility of what we do, and really share the fact that we're a first mover, market leader that sees an opportunity to create change, positive change in our industries. So the last 5 years, we started at 360, we ended up at $1 billion. Our fiscal year end is Monday, next Monday, and we'll meet or exceed that. So 3 times growth. We're proud of that. The lessons learned, customer segmentation. As we've continued to expand our market, every segment might have slightly different needs. Government has slightly different needs from retailers, which have slightly different needs from an industrial manufacturer. So you understand those differences and tailor your services to meet their needs. External growth is another avenue. It's another tool in your toolbox. So using acquisitions as a strategy to complement your organic growth has proved to be successful. And how to go global. We tested some ideas internationally in our retail supply chain business. It was operationally intense, expensive. Certain markets didn't have the appetite to do B2B transactions, so we folded a small operation in 2008 and then came back to the international markets with our capital assets business, selling high-value equipment in a consignment model that didn't require operational warehouse space, and that's been a big winner for us. So understanding how to go global, managing a culture globally, the understanding and norms in different countries are different, so we've spent a lot of time developing a global HR team, a compliance team, an intranet that connects people to our mission, in 10 different time zones. So that's been important. And I'm going to just breeze through this because we're going to want to end on a good time here. So today we have this great marketplace, robust marketplace, a win-win value proposition for buyers and sellers. Great trusted relationships with market leaders, thought leaders in all of the industry categories, from retail, government, transportation. That's the currency for us, is the trust they place in our marketplace. We've got great macro trends. We've got the fact that there's a lot of complexity in manufacturing, in technology-based products, smartphones, tablet devices, and with product innovation becomes product obsolescence. We drive more value for products that need to be tracked, managed, and sold. So this is driving a lot of value for us. E-commerce, the secular growth of e-commerce, which is now over 11% of the overall retail marketplace, has a higher returns rate and resulting in more flow of goods into our potential marketplace. Finally, sustainability. I think there's a new norm in the corporate world, in the manufacturing world, in the government world about reuse, recycle, recover value, don't discard items as waste. And we've helped agencies respond to that call for sustainability by allowing them to recover value from everything from commodities and scrap material to less than current smartphones, consumer electronics. We allow retailers to find new markets for hundreds of different product categories, all to meet sustainability objectives. And we think this is a great macro trend that will help our business. So our goal is to double the business from $1 billion to $2 billion in the next 3 years. And we upped that by $500 million after fiscal 12. And we're using this three-pronged growth strategy, organic growth, serve both sides of the marketplace, serve and penetrate sellers and grow our buyer base. Make sure you have great products, great customer experience, expand into verticals that are complementary, and acquisitions. So that's the business side. And we've had just a wonderful experience touching a market that was underserved, lacked technology, was inefficient, and we've been able to create a global market leader in our space, and we think the best is yet to come. And so when I reflect back, sitting in your seat, being a student, what was Notre Dame and how did it impact, the way I looked at the world? And in retrospect, what are some of the virtues of your experience? Well, one, Notre Dame is the embodiment of strong values and having faith and conviction and being a better place. It'd be a beacon of light for the rest of the world. When you look at the history of Notre Dame, and I expect everyone to know the history really well by the time they leave here, Ed Soren, at age 28, founded the university in a prairie in Indiana in the winter, really very limited resources, really no expectation of being a great global university, but really persevered. When he was 65, the entire university burned to the ground. So he spent a lifetime building a place only to see it burn to the ground. And what was his response? Well, those that know the history know that he was not in any way intimidated by that. He was emboldened by that. And he said, we're going to build a new building, a new university that's going to be bigger and better and bolder than what we just inherited. That's the faith and values. This is a university, the history, shut out of the Big Ten. No one wanted to play Irish immigrants. And really cast aspersions on that heritage, and that became the Fighting Irish. So we had this underdog mentality, and Knute Rockne, to his credit, as a very entrepreneurial person, said, if we can't play the Big Ten, we're just going to go wherever they'll let us play, and we'll take the show on the road. And he started going to the East, going to the West, getting on the trains, and that created a national following. A brilliant move by the university is giving away radio rights for free. And you've got all these immigrants in the United States learning about this underdog school with this great football program. There must be something special here. That was an inflection point in the history of Notre Dame. So this place has always been an underdog, always been entrepreneurial. Think about this. I think the endowment in 1960 was like single-digit $5-7 million. It's $6 billion today because the values of this place reach far beyond the student body. And so that's something that will always stay with you. Teamwork, okay? You come to this university, you get involved with things, okay? You get involved with extracurricular activities, non-varsity athletics. That's what you learn at a university. It's not sitting behind the desk. It's getting out with your peers and learning from your peers and getting involved, getting your hands dirty. Courage. It's very lonely starting a business. You're going to take a lot. There are going to be a lot of people that will criticize you or challenge you or maybe doubt you. It can be lonely. The only other time I felt like that is going into the Bengal bouts arena. You're very alone when you're seeing your opponent coming in. But that's something you all need to think about. Get outside your comfort zone. Try something new. Push yourself. Take a risk, because you'll learn a lot from that. So I think we all share pursuit of excellence. And anyone here knows, hey, look at this. 4 years in a row, number one. That's fantastic. I mean, Roger Huang's not here, but how about a round of applause for the dean and this number one school 4 years in a row. And it's not easy staying on top once you're on top. But this really lays it out here. All of the programs continue to do great within the Mendoza College, and you should be very proud of that. And in your own lives, far beyond university, you've got to recognize that the university's depending on you. You're not great because you're a Notre Dame grad or alum. Notre Dame is great because of what you go out and do in the world when you leave here. And so it's your obligation to make a mark on your community, on your neighborhood, in your place of business, to show that excellence. And then relationships. You have these relationships which last 20, 30, 50 years. You reflect on the people that you met and you worked with, and that continues on in life and becomes a gathering place, a place that you want to nurture and appreciate that these are special relationships that you have here, and enjoy that. And then in life and in business, relationships are going to be what drive your success. Lastly, pride. Let's beat the hell out of the Sooners tomorrow, okay? All right. That concludes our presentation.
I'd like to open up for quick questions here. I know we have about 5 minutes, and I think we've been outstanding conference. In fact, I think we may be offering you an adjunct tax. But anyways, I'd like to open up, give a few people an opportunity to ask some questions. As an incentive for those of you that may have come in late and were wondering how you would get credit, there's you up there answering a question, asking a question. So please, raise your hand and they'll bring a microphone over. Oh, really?
You talked about some of the challenges of going public. I was wondering if you'd comment a little bit on how you felt that affected you personally. Like, how was your personal life? How did that become different after you IPO'd?
Sure. I think that's a great point. When you examine what your tolerance for building a business, taking it public, you're thinking about how much time do I have to devote to that mission away from other things. Up to the point of being in a position to go public, there's certainly a lot of one-dimensional aspects of building a business. You're working pretty much around the clock for several years. So in my situation, knowing the commitment it took, I prepared for that. And at the time, young family or pre-kids, it was acceptable. Going public, you become familiar with the fact that we're in an era where you really don't have privacy, right? I mean, in the age of social media, in the age of Twitter, you're preparing yourself to live in an environment that has very little privacy, and therefore you want to make sure that all your decisions are sound, that if you make a decision, you're comfortable with that decision being on the front page of the Wall Street Journal or the New York Times. It's a great litmus test for how you think and behave when you have the type of disclosure that comes from being a public company. And so that's one aspect of it, but I think it's all what you make of it. I still think and behave in driving the business just as we did as a private company, and try to block out the noise or the distractions of short-term sentiment in the public marketplace, and just make those decisions tied to the truth of where we think the marketplace is and how we can succeed. So a lot of time and energy building a business. Make sure that if you get involved with that, you're comfortable with that type of commitment. But I think as you grow and prosper, your rewards are seeing team members that you've brought into the organization, you've given a career path, and you see their success unfold, and that's where you spend most of your time.
You're not going to get off that easy. Bill, I have a question. Wind the clock back 25, 26 years. You're now a senior or a young junior sitting right there in that audience. What piece of advice would, if you could now, what you know today, what you've experienced in your life, what key words of advice would you offer, would you want to hear if you were sitting in their seats now?
Sure. I think a lot of people go through this phase of they don't know exactly what they want to do, but there are probably some characteristics or passions they have. And I think the closer that you can come to finding a vocation that intersects two things, what you're good at doing and what you have fun doing, if you can get an overlap there, you're typically going to be very content and very successful. And so you need to define those circles. What am I good at doing? Your circle of competence. And what really gets you up? What gets you excited? What do you have fun doing? What keeps you engaged? And look for that intersection. And sometimes in the first few years out of school, you need to check things off the list because you don't quite know. You try something, you try a profession or a role. You say, well, I don't really care for that. Check that off. Well, that's success, right? You've just found something that doesn't fit those criteria, so you move to something else. And that's the journey of discovery. And the other thing that I would say is ask questions. If you have something that is interesting to you, go find the person who's best in the world at that. Ask them for a cup of coffee. And a high percentage of the time, they're going to embrace you because you're seeking that truth for you. And that truth for you is only going to be achieved by reaching out, interacting with the world, asking those questions. Don't be shy about that.
I know you're all watching the clock there at the end of our time here. So I'd like to extend a warm thank you again.
Thank you. Thank you.